This is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, here on June 23rd of 2020. Welcome you to this week's edition of what we're going to call Charts of the Week. So this week I'm going to actually separate the market comments from our charts and just spend a little time just kind of showing you some visual representations of our market and the economy. So we'll run through a handful of slides, and hopefully this will be informative to you, and we will have a separate recording for comments of the week and something that we might call a market minute, so stay tuned for that. Please see our disclaimer for important information. So in our first chart of the evening, we're going to show you weekly initial unemployment claims. There's probably a more important number that we should be tracking right now, and that's continuing claims. But what we see in this one is the obvious spike that we had when the economy was shut down towards the end of March. But it's been clear in some of the articles that you may have seen that number has come down quite a bit. And here you can see it visually represented as a continuous kind of decline, but still well above the historical norm, which I will say, if you look at the January through March time frame, I mean, that was a really a historic low. I mean, if you look over a longer term trend line, that's just exceptionally low. But obviously we're still well above that, but the numbers have come down quite a bit, which is of course positive when you think about the massive dislocation that we saw back in March and April. Here's a depiction of retail sales, and we know that when the economy shut down, that retail sales were just cataclysmically cratered. Businesses were, non-essential businesses were told to close. Even the essential businesses that were impacted to some degree, if you weren't basically selling staples or home improvement or the like. But here, I mean, we can see, not so much drawing your attention to the magnitude of the drop, which was profound in its own right, but also the rebound. And so in the gray in the bars, you can see the actual month over month changes. So obviously, as you track through January of last year, of 2019, through the end of that year, you can see modest adjustments from month to month, but basically modestly positive. And then in March and April was when we saw the major devastation. So, I mean, we had a large spike. Obviously, we're still well below retail sales numbers heading into the COVID-19 pandemic. But you can see, at least from a percentage gain, what we saw was a huge build back as some of these economies were reopened. Now, the one thing that we're going to have to watch with the most recent resurgence in cases for this phase one, as these economies have been opened, and we went through the Memorial Day weekend where obviously a lot of people were socializing and not socially distancing, and many were not wearing masks. So we're seeing a case rise in COVID-19. So it'll be interesting to see to what extent we're able to sustain the rebound in retail sales heading into the remainder of the summer and into the fall. This is an interesting statistic that I've seen this represented in several different types of graphs and charts, but this is basically, if you own an iPhone and you go into your iPhone into the map utility or the app, and you create a routing request, you're trying to find a route from A to B. Well, this is a representation of all this. So if you are sharing your information with Apple, Apple is tracking this. So they're showing you the aggregate number of routing requests on a 7-day moving average, basically from the beginning of the year. And you can see it's somewhat steady, maybe slightly trending up through March. But when the economy shuts down and people are being imposed with a stay-at-home order, you can see how that cratered completely into April. So basically it was just half of what those routing requests were. And this is a number representing change on a 7-day moving average. And so um, basically you can see April, and as the economy start to pick up and people start to become mobile again, even towards the end of May the end of April and into May, before a lot of those stay-at-home orders were lifted in a lot of states. Now here in Texas, the economy began to open up essentially when the governor's orders expired on April 30th. But if you look at this nationwide, you can see that this continuous trend upward in routing requests, which is an indication of the level of mobility, to the point that now routing requests, at least the change in routing requests, exceed their levels prior to the pandemic. This is a chart which kind of plots your recessions in gray against the present situation index. And this is information that comes from the Conference Board, which publishes this data on a monthly basis. And then you also get from them the Consumer Expectations Index. So, what I want to draw your attention to, you can see the cyclicality of this as the present situation index as you head into recessions. I mean, there's a clear pattern which shows up here, and a wide variety, a wide variance of index readings for the present situation index. And so obviously we were trending up for many, many years. We were in a prolonged up cycle in this economy, and you could see where really that was shot to the core when we had the pandemic and the shutdown. And so you can see on the far right that blue line that just falls straight down. But interestingly enough, the Consumer Expectations Index, and this is consumers that are in this index or this survey, are looking out beyond what they can see in their front windshield, and they're looking down the road. And you can see how that number is typically more muted in terms of its amplitude than the blue line. And what is really relevant here is that when you trend over, if you really look from 2011 on, that expectations bar continued to rise ever so slightly. And here in this pandemic, it really just kind of rolled over slightly. And so this is important when we think about, what's happening in the market, what's happening with retail sales, that, if you're told to stay home, and your retailers that you go to, that you shop at, are not open, obviously that impacts you. But if your expectation is, hey, I'm looking out into 2021, 2022, I know this pandemic will pass, that type of feeling or sentiment gets captured in this amber line here. And it's interesting that, the blue line is rolled over rather significantly, but you didn't see a corresponding drop in that amber line. So I think this is something that we want to pay attention to as we, again, head into the remainder of the summer and in the fall, that expectations still remain okay, I'll call it, while the present situation index has rolled over quite considerably. This is a chart of money supply and velocity of money. Now, this can seem a little wonky, and I don't mean it to be, but basically the M2 money supply, which is a blue line, represents all the cash, all the currency in circulation, the currency you have in your wallet, currency you have under the mattress, wherever, your checking and savings deposits, time deposits like CDs and things like that. It is the broadest definition of currency or money supply that we have. And you can see that as it trends over various economic cycles, and really just pay attention to the profound jump that we've seen. So we've seen a huge surge in money supply as a result of the Federal Reserve actions to get money into the economy, the Treasury and the federal government instituting the fiscal stimulus. So, the PPP loans, the disaster loans to businesses, to creating money that's sending $1,200 checks to individuals and so on and so forth. So a huge surge in money supply. But the other thing I want to point your attention to, and this is kind of transmits into the next couple of charts is the M2 money velocity. And what that means is when the money's in circulation, how much is it changing hands? How much is it, you know, in inspiring the economy to grow? Because the more velocity you have with your money that's in your money supply, or money that's in circulation rather, the faster your economy is going to grow. And so, you know, despite having this massive surge of liquidity, I'll call it, liquidity defined as money supply or money stock in the economy, you're not seeing the corresponding response from velocity. So, you know, what does this tell you? Well, what it tells me is that you're having a huge jump in your savings rate, not only from a corporate standpoint, but also from a consumer and individual standpoint. And this is very typical in recessions, that savings rates jump high, but we've had a lot of stimulus that's hit bank accounts, and to a large degree, a lot of that money has yet to be spent. And so that's depicted very poignantly here in this graph, where we've seen the stock of money go up, but the turnover of that money not go up. So this is another kind of depiction of money supply in kind of the corporate world, but this is basically, you know, deals that are the companies are undertaking to raise cash to enhance their balance sheets, to really kind of bolster their financial condition to get through the pandemic. And, you know, the best example would be you know, the airlines that are going out and raising a lot of money and using their loyalty programs as collateral, and being more, you know, probably more creative than they've ever had to be before because of the magnitude of the decline in air travel and things like that. So, but that's one area. But there are a lot of companies, even technology companies, that are very well financially healed and very well prepared to tackle the pandemic, and very well suited to benefit from the pandemic. Even those companies are raising cash. So you can see here a rather historic rise in money raising activity. And again, this is money that's, you know, in some cases is being used to help pay workers and cover deficits and losses and things like that. But in a lot of cases, it's just raising money for seed corn to stick in that barrel in the back room just in case you need it. And frankly, we've not seen anything like this except for heading into the technology crunch, when you saw a lot of dot-coms go public that had, you know, barely even had a business plan, let alone sales and profits. That was probably the last time that we saw companies raise anywhere close to as much money as they have here in 2020. And this chart that I'll show you is just a plot of the index, the S&P 500 index in white, against the projected profit margin. And as you might expect, as you look from basically 2000, in each of those increments, you can see a pretty high and tight correlation between the projected profit margins, which is going to be basically on your left scale, against the index value, which is on your right-hand scale. And, you know, predictably, you know, when projected profit margins rolled over in 2006, 2007, you know, you eventually had a corresponding decrease in the index, and obviously that was the financial crisis. And as we kind of built ourselves out of that crisis, you could see kind of a dovetail between profit margin expectations coming out of that and the index beginning to rise. But as you get over into the current year in 2020, you can see you know, a little bit of that shock after February 19th, when the index rolled over, and right about that time, you know, everyone began to basically the wave of anxiety over the pandemic really hit the market square between the eyes, and so profit expectations completely rolled over, as did the market. But with these liquidity programs and the fiscal stimulus from the government, again, putting money in people's bank accounts, and then the promise or this lure of having a cure for or a vaccine for the pandemic got the market back on its heels. And so the market kind of forgot about what was going on about profits, which is rare. So the market came back and with a vengeance. Meanwhile, profit margin expectations continue to slide. And so this is really a extremely unusual event where there's been this kind of this almost this cognitive dissonance between profits and levels of the index. And so a lot of people say, and I think justifiably so, that the index has gotten ahead of itself. But what the chart is not kind of telling you in full is that by and large market participants have said, okay, this is a shock to the system. We have a pandemic, created a lot of dislocation, but you know what? When we get 18 to 24 months down the road, things are going to be hunky-dory again. And that's what the market's pricing in now. So this is the really kind of highlights the unusual nature of the current environment, specifically as it relates to profit expectations. And something that I thought would be helpful to show would be the level of our fiscal deficit. Now, this should come as absolutely no shock to anybody that we're going to have the largest fiscal deficit, budget deficit, as a percent of GDP that we've seen since World War II. And I think it probably suffices to say that we're going to have perhaps the largest drop in annualized GDP, or GDP is gross domestic product, basically equals the economy, that we've seen since World War II as well. But this is kind of a visual stimulus of how stark that expected drop is likely going to be for 2020. And continuing on the corporate thread, this is just a depiction of the number of companies in the S&P index that have either cut or canceled their dividends. And as you can see, as companies are hoarding cash, they're planning for the unknown, or they're reacting to a significant shock to their financial circumstances, that you've seen a really high number, highest that we've seen since 2009, of companies that have just literally canceled their dividend, and then a slightly higher number of those that have decreased their dividends. So again, in aggregate, it's the last 2 years have witnessed a kind of a gradual increase in companies that are perhaps more concerned with the dividend growth rate. But what this has implications for are companies that, strategies that rely on dividend growth rates, or even investors that, in light of a very low interest rate world or low yielding world on fixed income, are trying to find that income on the equity side. And this kind of flies a little bit in the face of that, with some pressure on perhaps some dividend growth rates on equities. And I will kind of conclude with this slide. This is again showing you the index value and the PE ratio, which is price to earnings. It's basically a measure of valuation. So the black line is the PE ratio, or the market valuation, and the amber line is the S&P 500 index, which is depicted on the left-hand scale. So obviously what this tells you is that the market has picked up considerably in its valuation, and again, it goes back to the chart that earnings expectations are going down, the market continues to go up, so valuations are going to go up, and they have consistently gone up since the trough in the market. At the same time that the index has kind of battled back. So what this tells you is that before, when we entered the year, I don't think anybody considered the market to have a lot of extra value, but it still went up. but it certainly has less value now if you look at it on the same metric that you did on January 1. But the market continues to migrate higher. So we'll have to monitor the PE ratio again over the coming months. It is not atypical at all in a recession or exiting a recession that you have an extremely high multiple, because then your earnings, you kind of grow into it over time, because you don't get as much outperformance in the stock market, but over time your earnings catch up to where that multiple is, and it becomes a lot more reasonable. And I would certainly expect that to be the case here. So with that, we will conclude the charts of the week for this week. Hope you've enjoyed this insight. Hope you found it helpful. As always, please feel free to reach out if you have any questions, comments. We'd love to hear from you, and thank you again, and hope you have a wonderful week.